Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shallett, Chief Investment Officer for Wealth Management, and today is Monday, October 14th, and I'm recording this from my office in Purchase, New York. China recently unveiled a surprise stimulus package aimed at pulling the economy out of a slump and back towards its historic 5% growth target. After more than 3 years of a bear market, in which the MSCI index has fallen almost 60% from peak to trough, news of a seemingly comprehensive stimulus plan reignited quote-unquote animal spirits and catalyzed a bit of a reflation trade in global commodities. Included in the package were these key measures. The People's Bank of China cut the policy rate by 20 basis points and reduced bank reserve requirements by 50 basis points. It also cut mortgage rates for existing borrowers by half a point while lowering the minimum down payment for second home purchases. In addition, policymakers committed about 800 billion yuan for bank balance sheet repair and for corporate share repurchases. They've also sent the equivalent of around $285 billion to local governments in hopes of boosting jobs and household consumption. Markets responded to these moves reflexively, and the MSCI China index surged by as much as 40% between mid-September and the first week in October. After some profit-taking, however, gains are now closer to 20% since the plans were originally revealed. These policy actions are obviously a welcome development. They seem to be a recognition of the urgency around the country's economic malaise and could help improve next year's GDP growth. But they also raise several questions. Will the stimulus be enough to restore consumer confidence and reignite domestic growth towards their historic 5% target? Does it go far enough to address the country's structural constraints around their debt, their weak demographics, and deflation? Or does it simply supercharge the traditional infrastructure/export machine, temporarily boosting global trade-related growth? Our analysis suggests that recent action may in fact be insufficient to truly usher in a new reflationary cycle. In other words, we're less sanguine that the actions thus far will be enough to address the structural issues facing China's real economy. The biggest of these is the residential property market, where prices have fallen amid excess supply, collapsing confidence, and a deflationary spiral of excess mortgage debt. Experts have suggested that nothing short of a GFC-style rescue program to buy mortgages would halt this negative spiral. MS & Co. research analysts estimate that such a program could cost up to 5 times more than what has currently been announced or is projected. Equally constraining has been the central bank's reticence to get aggressive about the real cost of capital. While nominal rates have fallen to around 3.6%, if adjusted for deflation, they're closer to 5%. Just for perspective, the 10-year U.S. real rate has stabilized around 1.5% in the last year, and this dynamic has kept the renminbi relatively high versus the U.S. dollar, when what would really help China is a weaker currency. Beyond that, there's also the issue of poor consumer sentiment, plus disappointing youth employment prospects and confusing messaging around the government's support of equity markets. Other potential risks include China's structural vulnerability around excess manufacturing capacity, as well as well-known geopolitical tensions. So overall, it's likely that these issues require a more aggressive approach from policymakers, including quantitative easing and more fiscal efforts. For now, we see recent action from Beijing as directionally constructive, but falling short of producing a new bull market. Investors should watch the renminbi for signs of strength, as that would be an indicator that stimulus efforts are actually working in the real economy. And considering adding to global non-U.S. and non-China emerging market equities as part of your diversified portfolio. U.S. cyclicals may also get a short-term boost from China's actions.